Welcome to the MUFG Global Markets FX Week Ahead podcast with Derek Halpenny, Head of Research, Global Markets EMEA and International Securities. It's Friday the 28th of February 2025, and joining Derek to pose some questions on the financial market themes for the week ahead is Seiko Kataoka-Fisher, Vice President from Japanese Customer Sales for EMEA in London. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only.
Okay. Hi, Derek.
Hi, Seiko.
Predicting what President Trump will do next is never easy, but what do you expect over the coming weeks in regards to the trade policies, and how will those expectations shape your views for the US dollar?
It's been each day this week, there's been a different angle or a different story or a different plan. So absolutely very difficult to predict. I guess front and focus is the Mexico and Canada and now China with another 10%, those tariffs going live on Tuesday. So we're in a very similar position to the end of January when the tariffs for the beginning of February were live until literally the day before. So a repetition of that could mean that we go into Monday and we get some greater volatility on Monday and then either they're postponed or not. It's difficult to predict. Certainly, if you look at dollar CAD, if you look at dollar MEX, the moves this week have been pretty marginal, like 0.6, 0.7% higher for dollar CAD. I think dollar CAD's come down a little bit since the data, which was stronger than expected in terms of Canada data, but dollar MEX pretty much unchanged this week. So very skeptical in terms of FX traders, in terms of the risks of those tariffs coming in next week. So there seems to be a pretty strong expectation that they won't be implemented, which kind of makes sense economically. You're talking about 42% of all US imports come from Mexico, Canada, and China. So to have a 20% additional tariff on China this month and next week, and then 25 on Canada and Mex, you're going to have a pretty notable impact on inflation over the coming months. And with inflation expectations already still pretty elevated, real yields coming down because nominal yields have been coming down faster. And then you have consumer confidence data indicating fears about inflation expectations. You could have a pretty nasty impact on macro sentiment and macroeconomic conditions over the next couple of months. So there is a good logical reason to expecting that he'll pull back at the last minute. And for the moment, that's our view. If that proves wrong, obviously dollar MEX is going to have a spike like we had on the 3rd of February, Monday the 3rd of February. And dollar CAD got up to close to 148. Those kind of moves seem quite likely again if we do get a delivery of those tariffs. So let's wait and see. But I think the bigger picture and the safer prediction to make with a bit more confidence is ultimately that there's a whole host of plans and suggestions that he's made in terms of tariffs. And I think we are going to go into a period of increased tariffs. Maybe China is more of his focus, and depending what happens on Tuesday, maybe it's Europe that is also in focus. He seems to have a big issue in terms of the auto sector. So auto tariffs in Europe certainly look like they're coming. So I think there's still more to come. And in that context, a stronger dollar over the short term, I think, still makes sense. What we've done, though, and is the level of dollar strength or the scale of dollar strength that we were assuming, which was about 4 to 5% stronger. That might have been maybe a little bit aggressive because a bit more of a pragmatic approach. Of course, let's wait and see what happens on Tuesday. But if there's a more pragmatic approach in terms of going sector by sector and making threats, but then pulling back, coupled with the fact that there is definitely more compelling evidence that the US economy is slowing. And then there's some positive elements in terms of Europe, the ceasefire in Ukraine that could be potentially coming. Energy prices have certainly dropped. Net, that's good for euro. All of that makes us a little bit more cautious in terms of the scale of dollar strength that's coming. So we've kind of toned down that level, and now we're not forecasting euro dollar below parity, but we're still forecasting dollar to strengthen by, certainly potentially 2, maybe even 3%. So getting down close to parity, but we're now assuming we don't go below. But it's still up in the air in terms of how aggressive Trump ultimately becomes.
All right, thank you. Move on to the Japanese yen. The Japanese yen remained the second best performing G10 currency this month as we approach month end, with only Swedish krona outperforming. So the yen has, however, weakened this week. Where next for the yen, given the developments in Japan and the broader US policy expectations?
The yen's definitely having a move weaker today. We had Tokyo inflation, which came in a bit weaker than expected. However, it is quite utility energy related because of subsidies. That's pulled the annual rate of energy lower. But if you look at the core Tokyo CPI, that remained unchanged at 1.9%. So underlying picture, I don't think has changed very much. And I think just the scale of yen strength maybe that we've had, as you mentioned, Seiko, the second best performer in G10 this month, we're getting a bit of pullback. But I think ultimately our view would be, we're sellers of dollar yen on rallies, and we're yen bullish. Obviously, you've got to pick your moments, but I think the trend has turned. We've had a rate hike, and what's different in terms of the rate hike that we had from the BOJ is that the tone and hawkishness of the BOJ has been maintained post the rate hike, and that's a shift from the strategy last year when they raised rates. They were a bit more cautious, a bit more balanced post rate hikes to kind of keep financial market order, whereas now it feels they're becoming more convinced on the need for further rate hikes. So we had policy board member Takata make reference to potentially a need for higher rates than expected because inflation is holding up. So when you look at the OAS curve, there hasn't been much shift at the front end meetings in terms of expectations of more hikes. But I think when you look at the terminal rate, 1 and 2 years, that has stabilized about 15 basis points higher. So we've seen the terminal rate move higher, and that's resulted obviously in JGB yields moving higher. And I think ultimately that is definitely supportive of yen strength. So just take, for example, the 10-year US-Japan spread. That's now indicative of dollar yen being closer to 140 than 150. So if those yields hold, then I think the upward pressure on the yen is going to persist. And ultimately hedging costs are coming down slowly, gradually, but steadily coming down. And as hedging costs come down in terms of the hedging costs for a Japanese investor into the United States, there's gradually increased incentive for more hedging of existing stock of fixed income in the US. And that's a yen buying flow that I think is going to gradually pick up from a Japanese investor perspective. And then when you look at the leveraged short yen positioning, you can definitely see that there's less conviction in running short yen positions than we had last year before we had the liquidation of yen shorts. We did have a pop-up in yen shorts, but they're now being liquidated again. We now have the smallest leveraged yen short position since I think the middle of December. So again, given the rate dynamic, there's going to be more caution amongst speculators to be running short yen positions. And I think that dynamic is changing as well. And that ultimately is going to be yen supportive as well. So I would certainly be of the view that, any bouts of yen depreciation are opportunities to buy the yen.
Okay. Last question. There's no FX Weekly this week due to the FX Outlook Monthly being released on Monday. But are you running any trade views to update listeners about?
Yeah, so with the FX Weekly last week, we are going from what we were just talking about. We have a short euro yen position. So again, I've kind of run through the yen dynamic and why we're bullish on the yen. I kind of touched on there still being scope for the euro to drop from here, not significantly, but even a couple of big figures on euro dollar down to maybe 102, and dollar yen in that environment not moving particularly higher is going to result in euro yen moving lower. And I think, certainly over the short term, Trump's radar seems to be definitely moving towards Europe in terms of the potential for tariffs. They might not come until maybe the 2nd of April. We've got reciprocal tariff plans to be implemented. And if it goes sector by sector, as I mentioned earlier, the auto sector is probably going to get hit. And in that sense, that's bad news for Germany, of course. So I'd still think there's scope for euro dollar to move to the downside, but just not as much as we thought before. But that still opens up scope for a lower euro yen. Other crosses I think could certainly benefit as well. Maybe short Korea yen is another one. Like dollar Korea has had a big move higher today, 1%. Korea is definitely more exposed when you talk about steel, when you talk obviously about semiconductor chips and autos. So if those tariffs start to be implemented even directly on Korea, but even indirectly, it is going to be disruptive, and that could undermine the Korean won. So there's still potential for further depreciation of the Korean won.
Very interesting. Thank you very much, Derek.
Okay, thanks, Seiko.
Thank you for listening to this MUFG Global Markets podcast. Rate, review, and subscribe, and contact your MUFG sales rep for more information. Come back next week for more insights from the Global Markets research team.